Broadcom just gave Wall Street a very clean debate. The stock jumped after a new 5-year Apple supply agreement. AI revenue is exploding, free cash flow is hitting record levels, and the market cap is now in the $1 trillion club. But the real question is this: is Broadcom becoming the most important AI infrastructure stock outside NVIDIA? Or is the market already pricing in too much perfection?
That is exactly the right conflict. Broadcom is not just another chip stock. It sits at the intersection of custom AI chips, AI networking, enterprise software, Apple supply, and massive free cash flow. Bulls see a durable AI infrastructure compounder. Bears see a stock where the valuation already assumes years of flawless AI growth, VMware execution, and customer concentration going perfectly.
Starting with the numbers, in fiscal Q2 2026, Broadcom reported about $2.2 billion in revenue, up sharply year over year. Semiconductor revenue reached $10.8 billion, up 143% year over year. Free cash flow was around $10.3 billion, close to half of revenue. That is not hype. Those are real numbers.
Exactly. The most important part is not just that revenue grew. It is the quality of the growth. AI semiconductor revenue is scaling quickly, and Broadcom is converting a massive amount of revenue into free cash flow. Many AI companies have the story, but not the cash. Broadcom has both. That is why the stock is being treated as a core AI infrastructure name.
The new Apple agreement adds another layer. Broadcom announced a 5-year supply deal for custom ASIC silicon processors for multiple generations of Apple products through 2031. The company did not disclose the exact dollar value, but the market clearly took it as a sign that Broadcom is still deeply embedded inside one of the most important technology supply chains in the world.
And the wording matters. This is not just the old story of wireless components and RF chips. The market is reading this as potentially more compute-oriented, more custom silicon, and more strategic. Apple wants more control over its hardware stack. Broadcom is one of the few companies with the custom silicon design capability, networking knowledge, and manufacturing ecosystem relationships to support that kind of roadmap.
So the bull case is not just Apple. It is Apple plus AI ASICs plus AI networking plus VMware cash flow.
Right. Broadcom is different from NVIDIA. NVIDIA dominates general-purpose GPUs and the CUDA software ecosystem. Broadcom is stronger in custom chips and networking. Hyperscalers that want their own AI accelerators can work with Broadcom to build application-specific chips. At the same time, AI clusters need massive networking bandwidth. That is where Broadcom's switching, routing, and connectivity portfolio matters.
That custom ASIC angle is important. Not every AI workload needs a general-purpose GPU forever. Some hyperscalers want custom silicon to reduce costs, improve efficiency, and control their own infrastructure.
Exactly. Custom AI accelerators are not replacing NVIDIA overnight, but they are becoming a serious part of the AI stack. If cloud giants keep spending tens of billions of dollars on AI infrastructure, they will look for ways to optimize performance per watt and performance per dollar. Broadcom benefits from that trend because it is one of the key suppliers behind custom accelerator programs.
And networking may be just as important. In huge AI clusters, the chips are only useful if the data can move fast enough.
That is the part many retail investors miss. AI is not just a chip story. It is a system story. You need compute, memory, networking, optics, storage, power, and software. Broadcom sits in networking silicon and custom acceleration, which means it benefits when AI clusters get larger and more complex. The bigger the cluster, the more important the network becomes.
So why does the bear case still matter? If revenue is growing, AI demand is real, Apple is signing deals, and free cash flow is strong, what are investors worried about?
3 things. First, valuation. Broadcom is now a giant company with a market cap around the $1.7 to $1.8 trillion range. At that size, the market is already assuming long-term AI leadership. Second, customer concentration. Custom AI chip revenue can be very large, but it can also depend on a small number of hyperscale customers. Third, execution risk. VMware integration, AI chip ramps, networking demand, and Apple supply all have to keep working at the same time.
Let's unpack valuation first. A $1 trillion plus stock can still go higher, but the margin for disappointment is much smaller.
Exactly. When a company is valued like an AI infrastructure winner, investors stop rewarding promises and start demanding consistency. If AI semiconductor revenue keeps beating expectations, the valuation can hold. But if guidance slows, if a hyperscale customer delays orders, or if AI spending expectations cool even slightly, the stock can reprice fast. At this size, small changes in growth assumptions can move hundreds of billions of dollars in market value.
Customer concentration is another key risk. Broadcom's AI business is powerful, but custom silicon is not the same as selling standard chips to everyone.
Right. Custom ASIC programs are deep and sticky, but they are concentrated. A few large customers can drive a huge amount of revenue. That creates operating leverage when things go well, but it also means order timing and customer decisions matter a lot. If one major customer changes its roadmap, delays a ramp, or shifts spending, the revenue impact can be meaningful.
What about VMware? Some investors love the software cash flow. Others worry that cost cuts and integration gains may be front-loaded.
VMware is a major part of the story. Broadcom has a long history of buying assets, cutting costs, improving margins, and turning them into cash machines. VMware fits that playbook. It adds recurring software revenue and supports the free cash flow profile. But the bear case says the easiest integration gains may not last forever. After the first waves of cost optimization, growth has to come from product execution and customer retention, not just restructuring.
That is important because the market is valuing Broadcom as both an AI semiconductor winner and a software cash flow machine.
Exactly. The bull case works best when both sides are firing, AI semiconductors grow fast, and VMware produces stable cash flow. If one side slows, the other side can support the business. But if investors start questioning both at the same time, the stock becomes more vulnerable.
Let's compare Broadcom with NVIDIA for a second. Is Broadcom really an NVIDIA alternative?
It is not a direct replacement. NVIDIA is the king of GPU compute, software ecosystem, and AI training infrastructure. Broadcom is more of a custom silicon and networking infrastructure powerhouse. The better comparison is this: NVIDIA sells the engine everyone knows. Broadcom helps build the custom engines and the highway system around the data center. Both can win in AI, but they win in different layers.
So calling Broadcom the next NVIDIA is probably too simplistic.
Yes. The cleaner framing is Broadcom is one of the biggest beneficiaries of AI infrastructure complexity. As AI systems get larger, hyperscalers need more custom silicon and better networking. Broadcom is positioned for both, but the stock should not be judged by NVIDIA's story. It needs to be judged by its own AI revenue growth, customer pipeline, margins, and free cash flow.
The Apple deal also has two sides. Bulls see validation. Bears may ask whether Apple dependence is still a risk.
That is fair. Apple is one of the best customers in the world, but it is also a demanding customer with strong bargaining power. A 5-year agreement through 2031 shows Broadcom remains strategically relevant, but investors should still watch how much of the Apple relationship is expanding into new custom silicon versus staying tied to existing component categories. The more compute-oriented the relationship becomes, the more valuable the story. The more it stays in mature components, the less it changes the long-term thesis.
So the Apple deal is positive, but the details matter.
Exactly. The headline is strong. The unknown is how much revenue, what product categories, what margins, and how strategic the silicon really is. Markets often move first on the headline and ask deeper questions later.
Now let's talk about free cash flow. Broadcom's free cash flow is one of the biggest reasons the stock is treated differently from many other AI names.
That is a major point. Free cash flow around $10.3 billion in one quarter is enormous. It gives Broadcom flexibility, dividends, buybacks, debt reduction, acquisitions, and investment in future AI programs. Many high-growth AI stories require investors to wait years for cash generation. Broadcom is already generating cash at scale.
That also makes the valuation debate more nuanced. It is expensive, but it is not a no-profit bubble.
Exactly. Broadcom is expensive because it is very profitable, strategically positioned, and exposed to huge AI demand. The risk is not that the company is fake. The risk is that the market may be pricing a great company as if nothing can go wrong.
What would make the bull case stronger from here?
3 things. First, AI semiconductor revenue keeps growing above expectations. Second, Broadcom shows that AI networking and custom accelerators are both expanding, not just one product cycle. Third, VMware continues to produce high-margin recurring cash flow without major customer pushback. If those 3 things happen, the stock can continue to be treated as a premium AI infrastructure platform.
And what would make the bear case stronger?
A slowdown in AI revenue guidance, margin pressure from customer mix, weakness in networking demand, or any sign that VMware growth is being driven mostly by price increases and cost cuts rather than durable customer value. Also, if Apple details disappoint or the market decides the deal is more mature component supply than strategic AI silicon, the excitement could fade.
So this is not a simple hype stock. but it is also not risk-free.
Right. Broadcom is one of the highest quality AI infrastructure companies in the market. But high quality does not cancel valuation risk. The debate is whether Broadcom deserves a premium because it has AI growth plus software cash flow, or whether that premium has already stretched too far after the stock's massive run.
Give us the checklist. What should investors watch next?
There are 5 numbers I would track. First, quarterly AI semiconductor revenue, especially whether it keeps growing beyond the $10.8 billion Q2 level. Second, AI networking growth, because networking is the hidden infrastructure layer behind large AI clusters. Third, free cash flow margin, because Broadcom's premium depends on converting growth into cash. Fourth, VMware revenue retention and operating performance, to see whether the software cash machine remains durable. Fifth, customer concentration and custom ASIC pipeline, because the AI story depends on large hyperscaler programs continuing to ramp.
Final takeaway. Broadcom is not just riding AI hype. It has real AI revenue, real Apple validation, real networking exposure, and real free cash flow. But at a market cap around the high trillion-dollar range, expectations are also real. The stock can keep working if AI revenue, custom silicon, networking, and VMware cash flow all keep delivering. If any of those pillars wobble, the valuation can get tested quickly.
Exactly. Broadcom may be one of the best AI infrastructure businesses outside NVIDIA, but that does not mean every price is automatically safe. This is a great company facing a very high expectations test.
Tell us what stock you want us to break down next.
This video is for educational purposes only and is not financial advice.